There are a lot of different ways to categorize stocks, and we're going to talk about some of the more common categories of stocks. Blue chip stocks, for instance. They're issued by companies well known for their high quality as an investment. They typically have wide acceptance of their products and services, household names, if you will. They're established as being consistent profit making, and the company generally has the ability to pay dividends. There's no absolute definitive quantitative categorization for blue chip stocks, but that's a generalization. Value stocks are generally issued by established companies and pay at least a market dividend. They exhibit a ratio of price to earnings, that is price divided by earnings per share, lower than the market and may be less volatile than the average stock. Value stocks are those with lower than market PE ratios, price to book ratios, and higher than market dividend yield. As a consequence, value stocks usually have a low earnings per share growth rate than do growth stocks. They can be expected to be less volatile in terms of price than can growth stocks. And there are some relative merits of growth versus value. They cycle. When a growth stock is up, generally, a value stock may not be up quite as much, and so on. They don't always follow in lockstep. We'll talk about that in a later session. Then there are income stocks. Those are stocks that pay dividends higher than the average stock, and they may vary in terms of their quality. Utility companies are income stocks, and they usually pay an unusually high dividend, but they may have to do so in order to attract investors. Interest-sensitive stocks fluctuate in value as interest rates change. So by definition, income stocks would be also generally interest-sensitive. As rates go up, their value goes down, and vice versa. Utility companies, financial institutions, they're generally interest rate sensitive. Interest-sensitive stocks generally have a positive correlation to the bond market. That is, their behavior resembles bonds, going up and down roughly the same as bonds do. Then there are growth stocks. Growth stocks are those that represent companies usually growing their business at a rapid rate. Instead of paying out dividends to investors, growth companies invest all of their money back into the corporation for new research and development, for new products, etc. They may have high appreciation potential, but they may also exhibit wide volatility in stock price. Cyclical stocks are stocks that whose value changes generally in relation to how the economy is doing. Companies that are strongly influenced by the business cycle. They may flourish in good times and suffer when the economy dips. Entertainment companies are examples of cyclical stocks. As the economy changes, some cyclical stocks will benefit, some will be hurt. Some examples of cyclical stocks include auto companies, consumer cyclicals, entertainment, steel, and paper. They may flourish in good times and suffer when the economy dips. Airlines, for example, tend to lose money when business and pleasure travel are cut back. When the economy slows down, cyclical stock prices typically fall because company earnings are down as well. But when the economy recovers, the cycle may work in your favor. Earnings will probably rise and the price may go up. Then there's international and global equities. International equities in the United States are all stocks issued by countries other than the United States. In the U.S. markets, they are most often represented by ADRs, American Depository Receipts. We'll talk about those later. Global equities include U.S. stocks and international stocks. A note about stocks. There are some things that impact the value of stock that aren't necessarily supply and demand related. Stock splits, for example. When a board of a company wants to increase the number of shares outstanding, they may vote to split the shares. So, for example, if you own a stock selling at $100 a share, they may split it 2 for 1. So now you own, if you owned 100 shares, you now may own 200 shares of a $50 stock. It doubles the number of existing shares and cuts the price in half. A split doesn't change the value of the investment. Either way, you have the same amount you do when you started, and then it's left to supply and demand, which will drive the price of the stock up, down, or sideways. A stock may be split 2 for 1, 3 for 1, 10 for 1, And the reason includes the desire to demonstrate a lower price in order to attract more potential shareholders. However, the net result to prior shareholders is even up at the end of the day. An example of a stock split occurred with Berkshire Hathaway. They had two classes of stock, A and B, and Class A stock sold for over $100,000 a share. Class B stock sold for $3,000 a share. Well, Berkshire Hathaway split something like 50-1, and they created the same amount of money, but they created 50 shares at $70 a share, where you previously owned one share at $3,500. That occurred, it's 2009 probably. Another impact on stock prices are dividends. A stock dividend is like a cash dividend, but it's paid back to shareholders in more stock. And it may be the stock of the original company, an acquired company, or a subsidiary. You often see that when companies are spinning off subsidiaries. They will dividend stock rights and stock in the spun off company to shareholders. Then there are warrants and futures and other rights. A warrant gives the client a right to purchase stocks at a predetermined price at some point in the future. Ideally, the stock will be worth more than the price of the warrant at the time to exercise the purchase in the future. Warrants are often offered with stocks as an incentive to purchase the stock.